Here is a summary of the U.S. stock market for the week of July 14th, 2025, and a preview for the week beginning July 21st. Last week, the three major U.S. indices showed mixed results. Strong technology sector performance drove both the Nasdaq and S&P 500 higher, with gains of 1.51% and 0.59% respectively, while the Dow Jones edged down 0.07%. Meanwhile, the dollar strengthened as gold and oil retreated, with Treasury yields showing mixed movement. Several key factors influenced market dynamics. First, regarding U.S. tariff policy, market tensions rose early in the week following warnings of high tariffs on the EU and Mexico, alongside a secondary tariff threat against Russia. However, a subsequent statement that dialogue remains open led the market to interpret this as a negotiating posture. This sentiment reflects a pattern where initial threats are often followed by diplomatic engagement. Second, economic indicators presented a mixed picture. A rebound in CPI amplified concerns about tariff-induced inflation. Conversely, a slowdown in PPI partially offset some of this upward price pressure. Furthermore, strong retail sales data helped mitigate concerns over a potential slowdown in consumer spending. Third, a significant legislative development occurred with the passage of a comprehensive cryptocurrency bill. This legislation, which addresses the regulation of stablecoins and other digital assets, passed the House of Representatives and was signed into law by the president, marking a pivotal moment for the institutionalization of the asset class. Analyzing sector performance, technology stocks led the market's advance, with utilities, consumer discretionary, and industrials also posting gains. Energy emerged as the most significant laggard, dragged down by declining oil prices, while healthcare and materials sectors also retreated. Among individual companies, TSMC announced record earnings fueled by robust AI demand. ASML moved in the opposite direction, with shares tumbling after the company cut its outlook for the second half of the year. Regulatory developments benefited NVIDIA and AMD, as the U.S. allowed them to resume their H2O chips exports to China, though the decision drew criticism from some Republican lawmakers. Tesla attracted bargain hunters on multiple fronts. Its XIA division secured a defense contract, the company unveiled a new model, and ARK funds made significant purchases. The tech giants continued their AI infrastructure push. Alphabet secured a hydropower contract for its operations, while Meta broke ground on new data center construction. Netflix closed out the earnings parade with second-quarter results that beat expectations, yet shares fell as management trimmed profit margin guidance for the year's second half. Looking ahead to the week of July 21st, the market's direction will likely be determined by big tech earnings, monetary policy decisions from central banks, and ongoing uncertainty related to tariffs. The key events to monitor begin with earnings reports from Tesla and Alphabet on Wednesday. For Tesla, the market will focus on updates regarding its robotaxi project and sales figures for its new models. For Alphabet, attention will be on its cloud segment's growth trajectory and its capital expenditures related to artificial intelligence. On the monetary policy front, a speech by Federal Reserve Chair Powell on Tuesday will be closely watched, as it is his final public address before the FOMC blackout period. The market is keen to hear his latest stance on potential interest rate cuts. Key economic data this week includes the U.S. Manufacturing and Services PMI, also scheduled for release on Thursday. Politically, any further comments or negotiations related to President Trump's tariff policy will remain a significant variable. In summary, the prevailing market outlook suggests a 45% probability of consolidation or sideways movement. The earnings results from Tesla and Alphabet on Wednesday are anticipated to be the most significant catalysts for the market's overall direction. We must also consider the primary risks currently facing the market. First is the issue of narrow market breadth. While the S&P 500 and Nasdaq have hit all-time highs, a handful of mega-cap tech stocks like NVIDIA have done most of the heavy lifting. Small and mid-caps tell a different story. Many are actually in negative territory, signaling an unhealthy market dynamic.
The gap between the equal weight and market cap weighted S&P 500 has widened to its most extreme level in 22 years, exposing just how fragile this rally really is. Second is the concern of high valuations. The S&P 500's price-to-earnings ratio stands at 22.3, a level significantly above its historical average and near all-time highs. This elevated valuation implies that even a minor disappointment in corporate earnings could trigger a substantial market correction, potentially in the range of 15 to 20%. Third is political uncertainty. The primary risk here is tariffs, with the August 1st deadline approaching. The imposition of tariffs represents a significant potential disruption, as it would directly fuel inflation and complicate the Federal Reserve's ability to implement rate cuts. Furthermore, political pressure on the Federal Reserve, including discussions about the potential removal of the Fed chair, adds another layer of volatility. In this environment, a prudent investment strategy emphasizes risk management. While market gains can be gradual, declines are often swift. Rather than liquidating all positions, a more strategic approach involves securing a cash position to manage risk in anticipation of a potential correction. We advise against emotional or momentum-driven trading. Maintaining a defensive position by holding shares in established mega-cap technology companies appears to be a sound strategy. Over the weekend, several important developments emerged. Chicago Federal Reserve President Austin Goolsbee warned that new tariffs could fuel inflation, thereby delaying the Federal Reserve's anticipated rate cuts. This highlights the precarious nature of the market's recent record highs, which have been driven by a narrow group of stocks, indicating poor market breadths. The primary uncertainty remains President Trump's tariff policy, with Fed officials like Goolsbee issuing strong warnings about its inflationary potential. The upcoming earnings reports from major tech firms like Tesla and Alphabet are therefore a critical inflection point that will determine the market's near-term trajectory. Given the high valuations, political uncertainty, and seasonal weakness, a cautious investment approach is warranted, favoring selective investment in high-quality companies and maintaining adequate cash reserves over aggressive buying. In trade news, China's exports of rare earth magnets to the U.S. surged by 660% month-over-month in June. This signals a rapid normalization of a critical mineral supply chain that had been disrupted by export controls over the past 2 months. This normalization is a direct result of the U.S.-China trade agreement reached in June, in which China eased export licensing procedures in exchange for the U.S. permitting the sale of specific NVIDIA AI chips to China. Finally, there are reports of a potential summit between President Trump and President Xi Jinping at the APEC conference in South Korea this October. The primary objective of such a meeting would be to establish a diplomatic floor to prevent an uncontrolled deterioration in relations ahead of the U.S. tariff deadline in August. This suggests that back-channel diplomatic efforts are underway, as both nations seek to find a way to get along. The potential summit, whether at APEC or informally in a third country beforehand, would represent a crucial opportunity for direct communication on contentious issues.